Hey guys, how's it going? It's Andy from Magoo Investing. Welcome back. I took yesterday off, admittedly, because I had a term paper that was due on Friday, and so I've been spending the past probably like 2 days writing a 15-page paper about an invasive toad species in Hawaii and Australia. And every time I have to stop making videos for a couple days and do a really long paper, by the time I finish it, I'm itching to get back to making a video. And so I'm really excited for today's video. Yesterday, when I was just kind of cruising along YouTube, I saw a video from Jeremy from Financial Education, and he was talking about 5 stocks that had been doing incredibly well during 2020 so far. When I was watching those videos, some of the things that popped out to me were the ones that he was talking about were often really expensive. 2 of the ones that I remember specifically were Amazon and Shopify. And Amazon currently trades for $2,500 and Shopify is around $700. And so these are really expensive stocks. And so I thought to myself, why don't I make a top 5 stocks to buy for companies that are under $25 right now? I've always focused on this channel about just being a normal investor, and some people aren't willing or able to shell out hundreds of dollars to buy single shares of these massive companies. And so this is kind of becoming a problem in the stock market. When you look at these massive companies, you think of stuff like Microsoft, which is trading for over $150 right now. And so the prices on the stock market are pretty arbitrary because companies can go in and do stock splits. And when you look at the history of Microsoft, they've had at least 7 stock splits, which make a lot of sense because they've been trading on the stock market for 3 decades at this point. And in this video, I wanted to talk about 5 of my favorite stocks that are currently priced underneath $25, which gives the opportunity for everyday investors to buy these stocks. And so while companies like Microsoft have done plenty of stock splits in the past, you can look at Berkshire Hathaway Class A, which is Warren Buffett's child, and that's currently trading for $265,000 per share. And they have actively said that they are never going to do a stock split. So I am personally never going to own any of those. And so as we get further along into the stock market, more companies are going to start getting more expensive. And a lot of these massive companies, I haven't heard any rumblings of them talking about any stock splits anytime soon. But before we get started, I have to say that I am not a financial advisor and this is not financial advice. Everything you hear in this video is just my own opinions, and you should do your own research before making any financial decisions. Also, if you've been enjoying these videos, I really appreciate it. Hit that like and subscribe button as it would help my channel out a lot. All right, now that I've introduced the topic, let's get right into it and talk about my first stock that's under $25. The first company I want to talk about is Zynga, ticker symbol ZNGA. This stock is currently trading for around $8.20 and it's up more than 30% year to date. Zynga is a mobile gaming company based out of the Bay Area, and I remember when I first talked about it, I was very impressed. And there was a lot to like, and the reason I didn't end up taking a position in it is because I ended up buying what's my favorite company in the gaming industry with Activision Blizzard. But Activision Blizzard is too expensive, so my second favorite for that sector would be Zynga. There's a lot to like about the video game sector overall right now. In my last video, I remember talking about the incredible increase that they've had in the past quarter with a record number of sales topping $11 billion, which is a 10% year-over-year increase. And so there's a lot to like, and that's why Activision has been doing so well, and Zynga has been also doing really well. And when I put up the 1-year chart, you can see a little bit of chop when the virus hit, but besides that, things look really good. But then when I put up that 5-year chart, whew, man, that looks really good. It's one of the most impressive 5-year charts I've seen in a long time. And I think that's specifically why I was so attracted to it when I talked about it in last winter. And so when I do show the all-time chart, there's a little bit of weird price action where it spiked and then crashed, and that's usually pretty common after an IPO where there's a lot of hype going into it. Then the hype disappears, maybe there's some poor market conditions at the time, and it pushes it down. But in the past 5 years, they've had incredible returns, and it's been so steady. And so when the company released earnings a couple weeks ago, they reported a 50% increase in sales, which is an incredible number. The current projections for the revenue in the next year is around $1.7 billion, which would be a 25% increase year over year. Their top 4 games accounted for around 85% of their revenue in that last quarter, which is a nice spread. I've talked on this channel a lot about really enjoying companies that have a nice diversity of income sources, and seeing 4 of their games making up 85% makes me feel pretty good. And there's been some talks about they have 3 new games that are being slowly released in the next year, and that should increase the overall revenue in the future. When we go to look at the fundamentals, you can see that the revenue has been pretty nice. There was a massive drop in 2014, and that was reflected by the share price. But that was more than 5 years ago, and that shows the recovery that the company has had and why that 5-year chart looks so good. When I saw their cash on hand as being $1.3 billion, I was pretty surprised because, I don't know, when I look at a lot of these companies, a lot of the firms that have been around for such a long time or have so many assets and are massive companies, I expect to have a lot of cash on hand. And I was just kind of surprised to see a mobile game company like Zynga having $1.3 billion of cash on hand. Zynga has recently taken on some long-term debt for the first time, but their debt to equity ratio is around 0.38, so that's still really low. And so based off the long-term debt, they have plenty of cash on hand to cover that, but that long-term debt is not scaring me off in the slightest. So overall, I really like Zynga. I think there's a lot to like. You're investing in the gaming industry that has been taken off recently and has done very well during these quarantine times. And especially when you look at the 5-year history of Zynga, you see fantastic returns, and the company seems to be set up very well on paper with their fundamentals to do well in the upcoming years. I love the fact that they have 3 new games that are coming out this year, which should increase the revenue sources from 4 main games to 7, and that's what I like to see. And so while I think Activision will be probably my only video game company I own, Zynga I think is a fantastic option, and it's a very cheap option, trading for around $8. And so that's why it was the first company I wanted to talk about on one of my favorite stocks to buy under $25. Let me know what you think about Zynga stock in the comment section down below. Next up, I want to talk about Snapchat, ticker symbol SNAP. This is a company that I have loved since the first day that I saw it, and it's been a part of my portfolio for around 6 months at this point. Currently, the company is trading for around $18 and it's up 9% year to date. When you look at the 1-year chart, things look pretty solid. And then you go to the 5-year chart and you can see the overall volatility that this company has had. 5 years ago, it was $30 and then it fell down to $6 and now we're back up to $18. And so that shows some of the risk involved with investing in a company like this. And I was talking about this pretty recently when the overall market fell. And I was talking that I wanted to add to my position, but I'm going to keep my position size relatively small on Snapchat because it has shown the incredible range it can go through in just a couple years. One of the ways that you can look at that is by looking at beta, and beta is a way to determine how far the stock is going to move compared to the overall market. A beta of 1.76 means that if the stock market goes up or down 1%, you expect Snapchat to move up or down 1.76%. And so as the stock market goes up a lot, Snapchat is going to go up significantly higher. But then if the stock market does go down, you expect it to fall further than the overall market. And so beta is a way for you to determine the overall risk associated with investing in specific companies. And so when I was looking for companies to invest in as the stock market was falling, some of the things I was looking for were low beta because they're not going to fall as far and they're going to remain relatively stable. But now if you think that the stock market's about to take off, seeing Snap having a beta of 1.76 could be a really attractive thing, in addition to all of the positive things I see with the company. So now let's start talking about the main reasons why I love Snapchat. And if we go to the last earnings report, which was exactly a month ago, some of the main things that I love are right in the front. The main thing is that they beat their expectations on users and revenue, and that ended up pushing the stock up 25 to 30% the following day. They had a 20% year-over-year increase in their daily average users, which I think is the most attractive thing about this company. They're showing that they can increase their revenue significantly, and they're increasing the amount of people that are using their platform. And some of the largest increases we saw were in the international markets that weren't Europe or the United States. And so it's mainly coming from India. And I've been seeing a lot of articles talking about their average revenue per user is the lowest in that region, but the speed that they're increasing their daily average users there, I'm expecting that to be the main source of success that the company sees in the future. There was also a 35% increase in their watch time on the Discover page, which is a great way for the company to make money. This is a lot of promoted posts, there's a lot of ads going on there, and so seeing that increase shows that I was kind of surprised. I didn't think that people actually use the Discover page, but it seems like the increases show that it could be a viable revenue source in the future. They currently have $2 billion on cash on hand, $1.2 billion in long-term debt, and their debt-to-equity ratio is surprisingly low for a tech company. Seeing that ratio be at 0.56 is surprisingly low. I feel like most of the times that I look at these tech companies that are relatively new, I expect to see a debt-to-equity ratio between 1 of 2 because they're spending a lot of money to expand, but seeing 0.56 and how much cash on hand they have, but seeing those numbers makes me feel really good about my long-term position. Snap is still posting losses overall, but my personal hope for 2020 is for them to go positive for the first time. And that's just kind of something that I've put out there. We'll have to see if that actually happens, but that's something I'm hoping to see. There have been some recent discussions about ad spending decreasing during the pandemic, but from the earnings reports that we've seen from Snap, Google, and Facebook, it looks like the spending is coming back. And the only company that did not show positive increases in revenue during the past quarter was Twitter, which is another company I love, but it does not fit under the umbrella of being a stock that costs less than $25. So overall, there's so much to like about Snap. Their increase in daily average users has been very attractive, and their expansion into the global market shows that they're going to be around for a long time. They have some problems where they're still negative on their quarterly earnings, but it's something that I'm hoping they'll fix in the future. And so there's a lot of risk associated with this company, especially with the ridiculous price movement we've seen in the past 5 years. Going from $30 down to $6 and now back up to $18 shows a lot of the risk associated with it. But all of the things I see on paper makes me feel very good about my position. Let me know what you think about Snapchat in the comment section down below. Next up, I want to talk about Sirius XM, ticker symbol SIRI. Currently, the company is trading for around $5 and it's down 28% year to date. And so admittedly, this isn't one of my favorite stocks or something I've ever owned in the past. I remember when I talked about it on this channel for the first time, I was pretty surprised by the overall fundamentals. But it's not one of my favorite stocks overall. I'll admit that I got to 4 stocks and I wanted to get to that 5th one, and SiriusXM was the best one I could find. And so SiriusXM is the broadcasting company that recently bought rights to Pandora in 2018. When I show you the 1-year chart, you can see how hard the overall company fell during the pandemic, and that makes a lot of sense compared to, and I have been talking a lot recently about companies that have been doing well, but the broader market has been falling a lot during March and going into April. And when I show the 5-year chart, I was pretty surprised to see that even with that 28% year-to-date drop, the company is still up 31% in the past 5 years. And so that overall level of stability was the thing that was very attractive to me when I first talked about this company towards the end of December, maybe going into January. Some of the really attractive things were the revenue chart, which I was very surprised at the increase that it's had over time and the fact that they have $8 billion in revenue in the past 12 months. Those were really surprising numbers to me. It was very interesting to see that the company does not have a lot of cash on hand, and historically they've never had a lot of cash on hand. And so that's something to watch going forward. And their long-term debt has been steadily increasing over the past, and that could be part of the Pandora deal where they bought them in 2018. But at this point, it's sitting around $8 billion. And at this point, that $8 billion matches their yearly revenue. And I would show the debt to equity ratio, but at this point, the chart is totally messed up because the shareholder equity is negative. And so as I said, this is not one of my favorite companies overall. It is a company that I would consider investing in that's under $25. It's probably the 5th place on this video. But it's just kind of a company that I had not considered had been doing so well recently. The fact that it's up still 30% in the past 5 years with this 28% drop year to date has been pretty impressive. And you see a lot of stability on the overall charts. Some of the things in the fundamentals do not look amazing to me, but besides that, the stability from the 5-year chart gives me a certain level of confidence where I would consider taking a small position in a company like SiriusXM. Obviously, they have some problems going forward, and I don't know if they're going to be around in 20 years, but a lot of their integration into the cars and Pandora overall makes it seem like a decent investment overall. And I'd love to hear what you guys have to say about SiriusXM, ticker symbol SIRI, in the comment section down below. Next up, let's talk about Bank of America, ticker symbol BAC. Currently, the company is trading for $23 and it's down 35% year to date. I've talked about the bank stocks pretty recently, but some of the main problems is basically the pandemic. They're currently the 2nd worst performing sector overall behind energy. And so it's not something that's particular to Bank of America. It's affecting the overall sector. And so when I show the 1-year chart, you can see how hard the company has been hit during the pandemic. But then when I show the 5-year chart, there's been a lot of growth and it is still significantly positive over that period. The 2 main things that I've identified that are problems for the banks are the interest rates being 0, which is a significant way that the banks make money, and the risk of bad loans in the future. As the risk of a recession comes in, there's going to be the potential that the loans aren't going to be repaid. And so the major banks have taken $25 billion in protection for loan provisions in case people don't pay back those loans. And so I like hearing that the companies are trying to protect themselves going forward. When you compare it to the last recession, it was a lot of the bank's fault that things happened. And so it does not appear like the banks are going to need to get as much aid as they needed back in 2008. And so that makes me feel pretty good. When this recession is going to come, which at this point it's like 99% sure, it doesn't look like it's going to be at fault of the banks. And so the banks are still going to struggle during this time. As I mentioned, when interest rates are still 0, they're going to have a lot of problems. And when you look at the overall sector, there's still a wide range of companies that have fallen during this time. Bank of America is down 35%, but Wells Fargo, ticker symbol WFC, is down around 55%. And so while in the past I've been picking stocks that have been significantly beat down, the things I see on Bank of America look pretty nice. Admittedly, if I had to pick one bank stock to invest in, it would be JP Morgan, which is ticker symbol JPM, mainly because of the fact that they've come out and said that their dividend is going to remain stable with a yield that's currently just below 4%. But based off of the $25 criteria, I think the best bank stock out there right now is Bank of America, ticker symbol BAC. So going forward, there's obviously a lot of risks. You have the potential of bad loans, you have the interest rates being 0, but if you're looking to invest in something that's been beat down significantly, I think bank stocks and airlines are a great place to look, and that's why I picked Bank of America, ticker symbol BAC, as one of my favorite stocks to invest in that's currently under $25. I'd love to hear what you guys have to say about the bank sector overall and Bank of America specifically, ticker symbol BAC, in the comment section down below. The last company I wanted to talk about is Delta, ticker symbol DAL. This is a company that's currently trading for around $23, and it's down 60% year to date. And when I made my video talking about Delta, I gave a pretty in-depth review of the company and why I decided to finally invest in it. And so if you missed that video, I'll throw that up right now. And so I'm not going to go as in-depth as I did in that video. But one of the main reasons why I decided to take a position in Delta has already paid off. And the main reason is I thought that when the good news started pouring in, these stocks were going to jump significantly. And we saw that this Monday when we saw a lot of optimism about a potential vaccine. And on Monday alone, the stock was up 14%. And during the past week, it's up around 18%. So I'll give kind of a summary of the main reasons why I like Delta. And the first one is for the overall sector, I don't know how much further the companies can go. We've talked about a lot of the problems that have been affecting the stocks already. But even in the past week where we had some horrible news about the potential for reopening of airports, these stocks didn't fall that far. They went from, or Delta specifically went from around $21 down to around $18. And so that's a significant fall, but I just don't know the percentage further that they can go. And so when you look at the overall discount that you're getting, for a long-term investment, I think it's got a lot of potential. Number two is if you're picking a company in a sector that's been beaten down, you want to pick the one that you have the most faith in. And when I look at the fundamentals of Delta, I see the most attractive parts. It has the best revenue, it has the best margins, and while it has the second best long-term debt to equity behind Southwest, I think it's the best set up in the future. I have had a lot of comments kind of asking me why I don't like Southwest more than Delta, and currently I do like Southwest a lot. The problem is, I think Southwest is going to be one of the first companies to recover, and mainly it's because they fly almost only domestic routes. And so as things start opening up, you don't have to worry about the international borders that a lot of the major airlines, stuff like Delta, has to worry about. And so when things do start opening up in the US fully, Southwest is probably going to be the first company to kind of get back to normal based off of the way that their business operates. But I'm looking for a long-term investment, and that's why I think the fact that Delta is at a bigger discount, when you look at Southwest, it has not fallen as far, and I think it's based off of the main factors that I just talked about. And so for a long-term investment, I see a lot of potential with Delta, and when you get the ability to invest in what I think is the best airline overall at a 60% discount, it's kind of hard to pass up. And overall, I think that Delta is the best long-term option for airlines. Also, Southwest is currently above $25, so it wouldn't have fit into this video. But I love Delta a lot overall, and I'm excited for it to be a position that I own for years to come. So I'd love to know what you guys have to say about the airline industry and Delta, ticker symbol DAL, in the comment section down below. That's the video. Those are my 5 stocks that I love that are currently priced under $25. At this point, we've seen a lot of rebounds in the stock market, but there are still cheap stocks that you can buy out there. And so there's a big difference between undervalued and cheap stocks. Cheap stocks are mainly for the newer investors or people that can't afford to shell out thousands of dollars on these massive companies. And so I wanted to show that there are stocks out there for everyone. You don't have to start investing with thousands of dollars. The cheapest stock I talked about in this video was Sirius, which was $5 a share. There's stuff like Zynga, which is $8. And so there's a wide variety of stocks you can invest in. And I wanted to show that there's plenty of options out there. And I'd love to know what you guys have to say about my 5 stocks in the comment section down below, and if I missed any fantastic company that's currently priced under $25 that I might have missed. Thanks for watching this video, stay inside, and I'll see you in the next episode.